Michael Burry was made famous by The Big Short, and he has correctly called every last major stock market crash. He successfully shorted the dot-com bubble in the early 2000s. He famously predicted and profited from the subprime mortgage crash that kickstarted the Great Recession. And more recently, he has called the latest downturn in tech stocks, warning of an imminent crash in tech back during the peak in November. And after the tech market did crash, with many stocks down as much as 40, 50, or even 60% since November, Burry tweeted recently under his Cassandra username on Twitter, "At least I tried." But as dramatic as that sounds, there may be even more to come. Burry has recently warned that the real crash hasn't even happened yet, hinting that the decline in tech is only the beginning and the entire economy could crash like it did in the 2008 housing bubble. So in this video, we'll be looking back at Burry's recent warnings to see what exactly he is seeing that indicates a crash is coming, seeing how other market gurus like Cathie Wood or Jeremy Grantham agree with him, and finally going over exactly what you can do to best protect yourself from Burry's predicted market crash. So hit the like button if you want, and let's start by talking about Burry's warnings for the most recent stock market bubble. Burry first made a name for himself on Wall Street during the early 2000s, when he correctly predicted and shorted the dot-com bubble in tech stocks. That bubble bursting resulted in many companies losing 99% of their value overnight, and Burry has hinted that he sees similarities between the current market and the market during the late 1990s. He later made his famous Big Short against the housing market, betting the entire economy would collapse due to a bubble in real estate. And when he turned out to be correct, he ended up making his investors $700 million, while he himself pocketed $100 million when the housing market ultimately collapsed. And more recently, Burry started issuing warning after warning that the market was on the brink of collapse in 2021. And while we have seen a substantial drop in the market since then, Burry says this is only the beginning. Early last year, Burry was not shy about voicing his concerns over the rise of meme stocks like GameStop or AMC, calling for their crash back in mid-2021. But what many investors may not realize is Burry actually laid the foundation for GameStop's meteoric rise when he bought a stake in the company way back in 2019, writing multiple letters to its board over how undervalued the company was at the time. He also called out stocks such as Tesla, saying enjoy it while it lasts back in early 2021. And more recently, in April 2022, he defended short sellers of Tesla against Elon Musk, saying Elon was only mad at short sellers because he needed Tesla stock to buy Twitter. And that wasn't the only time that Burry went after Elon. After rejecting Elon's claims that he was being charitable in selling stocks in November so he would pay more taxes, Burry instead speculated that Musk just wants to sell Tesla stock due to its high valuation. And Burry was just getting started. He expanded to calling out everything from Bitcoin to EV stocks to software as a service stocks, saying they are like the housing market in 2007. And while Burry appears to have been right in hindsight, with most meme stocks and high-flying tech stocks down around 50% since then, at the time he had many people who disagreed with him. Elon Musk called Burry a broken clock who was always calling for a crash, so eventually he'd be right. And celebrity investor Cathie Wood said he doesn't understand the fundamentals that are creating explosive growth and investment opportunities in the innovation space. Though that may have been due to Burry shorting Cathie Wood's ARK Invest fund at the time. But after warning for months that we were in a market bubble, Burry deleted his Twitter just as the market started to drop. And he also sold out of all of his US stock positions just before the start of 2022. And man, does this guy have good timing. Pretty soon, everything from GameStop to Tesla to ARK to software as a service stocks declined substantially from 2021. And today, it seems that Burry's warning that we were seeing the greatest speculative bubble of all time in all things by 2 orders of magnitude was correct. But Burry has also been calling for what he calls the mother of all crashes. And while the recent downturn has been bad, it's nothing compared to the complete economic collapse we saw in 2008. So what is Burry seeing now that points to an even bigger crash than we saw in 2008? Or maybe even bigger than the 1929 collapse that kickstarted the Great Depression? Burry's most recent tweet on the subject compares the current market to 2008, saying it's like watching a plane crash. This alludes to how Burry felt when he predicted the housing collapse that started the Great Recession, which he talked about to New York Magazine in 2015. In that interview, he said, "I felt like I was watching a plane crash. I actually had that dream again and again. I knew what was happening, but there was nothing I or anyone else could do to stop it." And Burry's tweet seems to indicate he feels the same way today, and that he sees the crash coming and feels powerless to stop it. This is also mirrored by the trades that Burry is making in the stock market. Burry has recently started a short position against Apple, one of the historically most stable stocks in the market. At the same time, he's taken positions in Google and Facebook's parent companies, Alphabet and Meta. This may be an indication that Burry sees how software stocks have crashed and and thinks that everything else is going to follow suit in the near future. It could also be based on worries around consumer spending. After all, Apple's products are not cheap, and if consumer spending declines dramatically, they could be hit by people cutting back on their big ticket purchases, like iPhones and MacBooks. It's pretty hard to buy a more expensive iPhone each year when you have less money next year than you did the year before. But why would Burry think that consumer spending will slow down? Well, it all comes down to the biggest crash we've seen yet. Not in one sector, not even in all of stocks. We could be headed for a full-on recession. Cathie has been saying for months that we are headed for a recession, and even though Michael Burry has disagreed with her in the past, he seems to agree with her this time. Jeremy Grantham, head of GMO, which is a firm with over $118 billion in assets under management, similarly warns that we are seeing a bubble not just in stocks, but in the housing market as well, and they are both set to burst. Which admittedly could just be fear-mongering, but there is actually data to back up some of these claims. One major indicator of this is the yield curve, which Cathie explains.
Every time the yield curve has inverted within 12 months to 18 months, we have been in a recession.
So just look at when the yield curve last inverted, and 1 to 1.5 years later, we generally see a recession. Well, guess what? The yield curve inverted in March 2022. So is the stock market spiraling out of control, and is Burry right that we're headed for a recession? And more importantly, what steps can you take to protect yourself today? Well, the first thing we need to understand is how much weight should we give to Burry's opinion. Now, Burry has called pretty much every previous crash in the market. That is true. But he's also predicted a lot of crashes that never actually happened. In that same 2015 interview with New York Magazine, Burry said another crisis was looming, but that was 7 years ago. If you had sold out of the stock market back in 2015, you would have missed out on around a 100% return in the S&P 500 since then, even accounting for the recent pullback. And you would have missed out on over tripling the value of tech stocks in the NASDAQ index. Burry similarly called for a crash in index funds, or just baskets of stocks that track the general stock market, way back in 2019. And again, we haven't seen a crash in those values yet. Now, that's not to say that Burry's predictions were wrong, because the market could always decline tomorrow, but the old saying could be true here. A broken clock is right 2 times a day. If you call for a crash every year, eventually you're gonna be right. But assuming Burry is right this time, how can we protect ourselves from a crash? Well, normally in a crash that only affects stocks, you can save yourself by diversifying into other assets like real estate or government bonds. The problem is, we're seeing record high home values across the country, leading many to expect housing may also be in a bubble. And with inflation currently sitting at 6.2% according to the CPI, or Consumer Price Index, government bonds that only pay out 1 to 2% per year are still going to lose you money over time. It honestly feels like the ultimate catch-22, where no matter where you put your money, it feels like you're gonna lose it. So what else can we do? Well, I've found that in times like this, I tend to look toward investors who have been through many stock market crashes and have continued to outperform over a long time horizon for advice. And in my opinion, no one fits that bill better than Warren Buffett, one of the most successful investors of all time. Now, even Buffett himself seemed to think that the market was overvalued in January of this year, with his Buffett indicator passing the 200% maximum he thinks is safe to invest in. This indicator is simply calculated by taking the market caps of all public stocks and dividing by the US GDP. And that then shows whether or not valuations are outpacing how much money the companies are actually making. So is that it then? Should we just sell? Well, not quite. Buffett also has the famous advice to be fearful when others are greedy and be greedy when others are fearful. So the real question we need to answer is, are we still in the greed phase of the market, or have we reached peak fear with the recent sell-off? Because if we could time that correctly, we could effectively predict when to pull money out of the market and when to put it back in. But as good as that sounds in theory, it's a lot harder in practice. Warren Buffett also suggests that most investors should simply buy and hold and not watch the market too closely. He said, "The money is made in investments by investing and by owning good companies for long periods of time. If they buy good companies, buy them over time, they're going to do fine 10, 20, 30 years from now." So instead of timing the market, Buffett says to focus on investing in great companies. That way, even if you buy right before a crash, if your time horizon is long enough, you should still make money in the long term. And this strategy of buy and hold over market timing is supported by the data. A Bank of America study compared the hypothetical returns of investing $1,000 into an S&P 500 index fund from 2010 until 2020 for the entire decade. If you had invested during that time, your $1,000 would be worth $2,900 by the end. But if you missed just the 10 best days in the market, you would only have $1,900 at the end. And for an even more dramatic example, we can extend that to look all the way back to 1930. 1930. If you had invested $1,000 in 1930, that would have turned into $150,000 by 2020. But if you had missed just the 10 best days each decade during that time, you would only have $1,900. So unless you have nearly perfect market timing, it's incredibly easy to miss out on huge market gains while you're waiting for the market to crash. Even if you had invested all of your money into volatile tech stocks in 2007, right before the stock market crashed, literally the worst timing that anyone could ever have. As long as you held through the crash and then subsequent recovery, you would have made all your money back by 2012, and you would have tripled your money between then and now. We can look back at advice that Buffett gave in an interview in 2017. Consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin. So while we could try to time the market and move our money out just before the crash and then jump back in once it's over, statistically your chances of timing it right are the same as just guessing, even if you're a famous investor. So my plan going forward will be to continue to dollar cost average into the market through a mix of broad market index funds that track the general stock market and some individual companies that I think will outperform over the next 10, 20, and 30 years. I know it seems too simple, especially when emotions are running high around a coming market crash, but according to every study out there, that is the actual way you beat the market in the long term. Now, if you want a guaranteed way to make at least some money in stocks, when you sign up for Moomoo using the link in the description, you'll get 5 free stocks worth between $300 and $3,500 each, which you could just sell a few months after earning them if you really want. I'm not saying to do that, but that is an option. So check them out using the link in the description to grab those 5 free stocks. Don't forget to like and subscribe, and I'll see you next time.